Sir, shall I wait for the students to join or should I start the class, sir?
Just start it. Just
Yeah. Okay. Yeah. Hope you can see this slide on. Yeah. Fine. So in today's class, we shall be discussing about the constituents of financial system. Now there are four: financial institutions, financial markets, financial instruments, and financial services. Let us see one after the other. One is financial institutions. Now, see, these financial institutions, they are nothing but they are established specially to transact money, okay, in the form of either savings or mobilizing savings and then lending them to the needy people. Okay, they can be consumers or they can be investors who would be again investing for a particular gain. Yeah, so this we call it as financial institutions. So financial institutions, what they are doing, they are bringing together investors and borrowers, and they are mobilizing resources either directly or indirectly through a number of financial instruments. Okay, so we can classify these financial institutions into various types, like no banking institutions, non-banking companies, investment banks or development banks, insurance companies. Okay, and like non-banking financial intermediaries like chit funds, yeah, mutual funds, indigenous bankers, and all these things. Okay, so this no, majorly what is the main function of this financial institution is they are no exchanging, or you can say they are transacting in money. Okay, by mobilizing the savings, and then from the savings they are lending to the entrepreneurs and other people, okay, who are in need. Okay, it can be consumers or it can be any other person who is investing in companies and all these things. Okay, so these financial institutions we are categorizing into three: regulatory and intermediaries, and non-intermediaries. Regulatory institutions, they are, yeah, Reserve Bank of India, SEBI, IRDA. They are all regulatory. They'll regulate, yeah, how much you can borrow, what should be the percentage of interest, yeah, what would be the repo rate that is decided by RBI. So they will be regulating the flow of money in the country. Okay. Then intermediaries, they include all types of banks and non-banking financial institutions. And non-intermediaries, they are institutions like insurance companies, mutual funds, etc. Okay, see, these are the banking institutions. Central bank, that is RBI in our country, then followed by commercial banks. Then we have cooperative banks, we have regional rural banks, private sector banks, and then local area banks and foreign, yeah, foreign banks and all these things. Okay, now let us see what the central bank is doing. So this is no apex bank. The first and the foremost, the topmost bank in the country, and they will be acting as a leader of money market. Okay, in India, RBI, as I told you, is a central bank, which is no usually has established as a private bank, by private sector bank in 1934. Okay, late and started functioning in 1935, but it is nationalized in the year 1949. So from that year onwards, it is now in a government body, okay, and regulatory body. So what the central bank is doing, it is doing all the functions of what a bank does. Okay, like issuing uniform currency, no rupee. The currency of our country is rupee, no. So likewise, they will be issuing uniform currency. Then it is a banker to govern government also. If you want, no, if any state government wants some money, they can approach central bank, Reserve Bank of India. So it's a bank to the government also, and it's a banker's bank also. So if SBI or HDFC they are in need of money, they can approach RBI. So it's a banker for a bank also, and it is a lender of last resort, and even it controls the credit of any country also. So it's a controller of credit. So main functions is issuing uniform currency, and then banker to government and bankers bank. Then it's a lender of last resort. No, you can approach the see if you don't have anything and all, you can approach. See in the family also, we'll just whatever problem comes and all, if your grandfather is there, we'll just address him, isn't it? So likewise, it's an apex bank, so therefore we'll approach this RBI as a last resort for any credit or control of credit. Okay, so it is through this last resort, I say what the government is doing is, I mean, what the central bank is doing is regulating the demand and supply of the currency. Okay, demand and supply of money and credit. So it is in one way regulating the whole financial sector. How it does is no, by way of permits, yeah, licensing, and then directives. So RBI in India, it has got so much autonomous powers, and therefore it is regulating the whole flow of credit and savings and all these things in the country. Now, when we look into commercial banks, see, commercial banks, we call it as the nucleus of money market. Okay, RBI is the apex body, and these commercial banks, they are the nucleus of the money market. What they are doing, they are connecting between these two, who savers and investors. So in one way, they are mobilizing the dormant savings from the hands of public through current accounts, savings accounts, yeah, as such, and time and cumulative deposits also, like fixed deposits and all these things, and that they will channelize into the hands of investors. How? By giving them short term loans, medium term loans, or long term credits. So in that way, they'll be taking savings from the people, households, and all these things, and they are investing in and giving money to the investors in terms of short term, long term, and medium term credit. So commercial banks, they are also acting as no purveyors of money, because no, their ability to manufacture money is not there, but it is in the hands of RBI. But they are safeguarding in one way. They are creating no money in the form of savings from people, and then investing. Yeah, so this happens with the commercial banks, so therefore they are acting as a agents of depositors. Okay, they are doing many functions. They are doing functions, no, financial services they are providing, like they are discounting bills. Yeah, and money transfers, payment of subscriptions and taxes, all these things. This is the work done by commercial banks. Okay. uh, Next, followed by this is cooperative banks. First is central bank, second one is commercial banks. Now, next is cooperative banks. So these cooperative banks now usually they dominate rural areas. Okay, rural bank credit we can say, rural bank credit structure also we can say. Now this cooperative credit delivery system, it got its recognition no, in the year 1912. Okay, with the enactment of Cooperative Societies Act 1912. So they are now regulated by RBI. So they have come with some basic principle, no, that let us help ourselves, let us help ourselves, no, like self help and mutual help. With that basic foundation, with that basic what we can say model or principle, this cooperative society has come into existence. Okay, this organization no, of short term credit structure, we can divide into three, that is we can call it as a three tier system. One is apex state cooperative banks, that would be operating at the state level. Then we have central cooperative banks that are working at the district level. And then we have primary cooperative societies at the village level. So village level, district level, and state level. So whatever the things at the village, that would be taken care by primary cooperative societies. They'll pool all savings from them, and they help, and mutual help would be done for the milk and the farm milk vendors and the farmers, and also at the village level. At the district level, it is being taken care by central cooperative societies, and at the state apex state cooperative banks. So these cooperatives, for a long time, they are considered as no only agencies which are meeting the needs of rural sector or rural people for only credit giving. Okay, especially in agriculture. Uh, but now they are almost multi-agency approach is now given. They are rural credit is involved, and agencies are giving rural credit. So post nationalization period, they have no witnessed the entry of commercial banks, regional rural banks, and local area banks. So they also have entered into giving rural credit to the people. Okay, so this is how cooperative banks are working. Next, we have regional rural banks. We call it as RRBs. So this is no by an ordinance of 1975. It has been passed, and it's uh, came into existence in 1976 onwards. And the main functions of RRBs are very similar to commercial banks, which we have seen in the second category. No, same they does. That is, they mobilize the savings and they lend it for investors in different forms, short and medium and long terms, like that they will distribute. So RRBs, they are mainly catering to the needs of the agricultural sector, micro and small or manufacturing units, and they are also taking care of this rural development programs also. Okay, so altogether around 196 RRBs are there in the country, and there is structural problems in the working of RBs, and their suggestions for their merger is the sponsoring banks and all. So they will totally depending on the central bank and all these things. Okay. Next is private sector banks. So the name itself is saying these private sector banks are exclusively in the hands of the private people. So this has gained momentum no after the recommendations given by Narsimham committee. Okay, and assurance that there will be no discrimination and no more nationalization. So therefore, private sector banks came into existence in the year 1993, and there are altogether 23 private sector banks operating in India, like HDFC and all these things, ICICI and all, IDBI and all these things. Okay, next is local area banks. These local area banks are established in the year 1996, and they are very small banks, local area, no? So small banks, and they are confined to a limited area of operating, especially either two or three districts only. And they have to operate under controls and regulations of RBI only, and their paid up capital is 5 crores only, and minimum of 2 crores can be contributed by the promoter himself. Okay, so why this local area banks are established is with an objective. Okay, and what that objective is to enable the mobilization of rural savings by local institutions only, and that should be made available for investment in that particular local area. It can be one or two districts, isn't it? Yeah. So thus, what it is doing, it is bringing the overall idea of to bridge the gaps in the credit availability in the rural and semi-urban areas. Okay. Now, what by this? No, they are strengthening the institutional credit mechanism in the whole country, especially in the local areas. Okay, so at present, five are working, and the last one is foreign banks. And these foreign banks, they are the banks incorporated outside India. That's why we call it foreign banks. And they have their head office in foreign country. And these banks are allowed to set up their we can call subsidiaries in India. Okay, and this has started in the year 2002 onwards. So at present, 46 foreign banks are there, and they are discharging the same functions as that of commercial banks and all. That is, no, just what banks does, they just mobilize savings and lend in the form of loans and all, right? They invest in different companies and all these things. So same thing foreign banks are also doing, but these are all no regularized by or regulated by, they are governed by the RBI. Okay, whatever the guidelines, directions RBI gives, all the other banks, commercial, cooperative, RRBs, private sectors, local area banks, and foreign banks, they have to acknowledge it. Okay, so this is that. Then we have non-banking institutions. See, apart from banks, no number of non-banking financial companies are there. We call it as NBFCs. Okay, and they are operating in this Indian financial system, and they are registered under Companies Act 1956. And Reserve Bank of India amendment is done in the year 1997, and they define this non-banking institution as, see these 3 points here, because we are saying it a company, and company has its own definition. You might have been learned in your business laws. Yeah, uh, where what company means. So here, when we are calling it as a non-banking institution, a company, so its definition is given by an amendment by RBI 1997, and what it is saying that a financial institution which is a company. So any financial institution which is a company, we call it as NBFC. Okay. So what company means? Yeah, it's an artificial person, right? Working with some documents being incorporated, and some rules and regulations I have to be followed to make it a company. So all these things that are done by this, so hence we call it as a company. And the second one is a non-banking institution which is a company, and which has its principal business the receiving of deposits under any scheme or arrangement, or in any other manner, or lending by in any manner. We call it as non-banking. thing is it's a company but doing the work as a bank. So that's why we call it as non-banking. They are mobilizing savings, they are receiving deposits, and they are investing and lending it to other people also. Same as what bank does, they are doing. But thing is, it's a company, right? Next, such other non-banking institution or class of such institution as the bank may, with the previous approval of the central government, specify. So whatever the central government is specifying, other than bank, okay. And if it is a company, all those institutions will come under the category of non-banking institution. So non-banking finance companies therefore consist mainly of finance companies which carry on hire purchase finance, housing finance, investment, loan, equipment leasing, or mutual benefit financial companies, but do not include insurance companies or stock exchanges or stock broking companies. So other than these three, insurance companies, exchanges or stock broking companies, and the regular banking, apart from these other things, all which are established as a company, they come as non-banking finance companies. Okay. And see, these are all non-banking institutions. I said no, equipment leasing companies. So if their main business is leasing equipments or they are financing such activity. Suppose my company needs a big machinery which costs crores of rupees and I'm unable to buy it, I can take it as a lease, okay, through this non-banking. Likewise, hire purchase, housing, finance, all these things as I told you. So So this is what is types of NBS. Next is financial markets. So what we have learned all is financial institutions. Now we shall see financial markets. What its meaning is, functions, and classification. See, financial market, you know what it is. What is market? It is a place where buyers and sellers meet, and we have added a word financial to it, right? So what it means, those buyers and sellers who are dealing with bills, who are dealing with commercial papers, who are dealing with bonds, who are dealing with shares, who are dealing with stocks or securities, yeah, or commodities or precious metals or currencies or some derivatives, then we call it as financial market. So that is what is given in the slide also. Financial market is the place where buyers and sellers of bills, commercial papers, bonds, shares, stocks, securities of different nature and maturity periods, including precious metals like gold and all these things, commodities, currencies, and derivatives, they are being bought and sold. So these instruments, when they are traded normally at low transaction costs, we call it as financial market. Yeah. And what are money market institutions, stock exchanges, they are also important agencies carrying on the above transactions. Okay, whatever I told. And in the financial markets. So what are the main functions of financial markets? Number one is they are mobilizing the dormant savings from the hands of large number of savers and channel them into the hands of needy investors. So in one way, they are also acting as a bank here. Okay, lot of savings from large numbers they are taking and they are providing them to needy investors. That is number one. Number two is they are providing an opportunity to lenders to earn either interest or income or dividend or that is interest income or dividend income on their idle resources. And this facilitates income generation both to the individual as well as the national income growth. So what this financial market they are doing is providing an opportunity to lender to earn either interest income or dividend income. See, usually even I have seen, see some of the homemakers, ladies and all, uh, they lend money by just keeping gold or earrings or necklace of somebody who are in need of, and they provide money with only 1% interest and all this. So it's an opportunity for them. No, they are gaining interest income. So like that from the idle sources, that their money was idle at home. So what they have done, they have lend it on some pawn, or you can say mortgage of earrings or necklace and all, and then giving in interest. So they are providing an opportunity. So that is nothing but financial market. And the third one is they are facilitating investors to mobilize funds on a large scale for investment easily, sometimes without the obligation of paying interest, but giving a share in profits in the form of dividends. So financial market, what they are doing, not just creating interest and all on the investment, but even giving the share in the profits in the form of dividends. Okay. And number four is prices of stocks and securities traded in the financial markets. They reflect demand and supply conditions and hence provide valuable information about the performance of business units and its financial soundness and solvency. Okay. So when they are trading in stocks and securities, which are no, reflecting the demand and supply conditions, so they give a lot of information for the investors. So whether to invest in this company or not, whether its financial condition is sound or not, it is very solvent or it is going towards insolvency. All such things you can know through your financial markets. Next is impart liquidity to the financial assets at the disposal of individuals and institutions, since they can be easily traded and converted into cash quickly. Okay, so impart liquidity to the financial assets at the disposal of individuals and institutions. Because no, say everybody wants cash and all that, and that cash should be whatever, no, it should be converted into cash quickly. So financial markets are providing that opportunity. And the sixth one is they facilitate capital formation, industrial development, entrepreneurship development, and also economic growth and development. See, when we are saying in a country where the financial markets are good, definitely economic growth and development is possible. That means facilitating investors to mobilize funds on large scale, okay, and getting interest income or dividend income. So as such, if they are providing and the financial market is good, then we would definitely say that the economic growth is possible. So when we divide Indian financial market, there are two things we have to understand. One is they are organized market and unorganized market, and government securities market and long-term loans market, even including mortgages. So these are the classification. One is organized market, unorganized market, government securities, and long-term loans market, including mortgages. Now, when we look into organized markets, the name itself is saying organized. Everything is systematic. Rules and regulations would be followed, or whatever RBI is saying, and all these things. We call it as organized market. So here, organized market, they consist of commercial banks, as we have seen, cooperative banks, financial institutions, development banks. They are all organized. Okay. And most organized they are divided into two, that is money market and capital market. A money market is what? It is a market that transacts in short term assets with maturity period of less than 1 year. The instrument traded in this market are commercial bills, bills of exchange, treasury bills, certificates of deposits, call money market, and other commercial papers. So these instruments are dealt in this market. Buying and selling is done. of these commercial banks, bills of exchange, treasury bills, certificates of deposits, called money market, and other consumer commercial papers. So give and take. And there's for a 1 year only. Hence we call it as a money market, very short term assets. Okay. Whereas capital markets, they deal in long term instruments like shares, stocks, bonds, and securities, and long term, so more than 1 year. Okay, more than 1 year. It can be 5 years or 10 years as such. And again, this capital market we can classify into primary market trades in the issues of new companies, and secondary market trades in the issues of existing companies. So again, these are two you have to understand. So primary market trades in the issues of new companies. So when new company is formed, issue of shares must be done. That would be primary market trades. And all already existing companies, if they are in need of more funds, they go for new issue of shares. That is secondary market trades. Okay, this is all about organized market. What is unorganized market? So that means no rules and regulations would be there. Okay, unorganized. And this consists of no large number of indigenous bankers, money lenders whose transactions fall outside the purview of RBI. That means RBI, whatever the transactions which are not controlled by RBI. Now, like you see, money lenders, they don't follow any rules and regulations, right? To some people they give it 5% interest, for some they give it for 2% interest only, whereas banks, they will not do like that. They have to follow the rules and regulations of RBI. So hence we are calling this market, where there are no rules, we call it as unorganized markets. Yeah. Next is government securities. So in this market, only government securities and gilt-edged securities, which are issued in the form of bonds and credit notes, they are traded. So exclusively related with government. Okay. Next, long-term loans market. They are issued by the banks and financial institutions. They include even mortgages and all pawn and all these things, and they fall in this long-term loans market. Yeah, any doubts still here? Okay, then. Now we should move to money markets. So what is money market? Money market is a part of financial market only, that is dealing with the short-term claims against money. Okay, the instruments transacted in money markets, as I told you in the previous slide also, that it is bills of exchange. So what is traded in this? Bills of exchange, treasury bills, and other commercial papers whose maturity period is only 1 year. Okay, so according to Reserve Bank of India, the money market is the center for dealing in monetary assets of a short-term character. As I said, 1 year. Okay, in the money market, the short-term surplus investable funds at the disposal of financial and other institutions and individuals are bid by borrowers comprising institutions and individuals, and also by the government. Thus, it meets short term requirements of borrowers and provides liquidity to lenders. Okay. So, in other words, see what we can understand, that money market, no, it's a market lending and borrowing of funds takes place. So remember that it is a place where market lending and borrowing of funds are taking place. Okay, and the transactions are meant for a short period only. It may be 1 year. Okay, and supply of funds, they are coming from central bank, commercial banks, and other financial institutions and individuals, And likewise, the demand for funds also comes from the government, merchants, manufacturers, farmers, stock exchange brokers, or banks, or others. Okay, so this is what we have to understand by money market. Okay. And if we look into all these things, what exactly is no the features of money market? Remember one thing: money market, they are transacts not just in money but also in near money assets like commercial papers and all these things. Okay, number one. Number two is the maturity period would be not more than 1 year. And third point is most of the money market transactions they take place between government agencies, commercial banks, and large corporations or corporate of good reputation and brands. Okay. Fourth one is money market transactions. They are conducted without any brokers, without any agents. Number five is uh, uh, central bank, in fact, no, it is acting as an agent, as a leader of this money market. And through its credit control weapons, the central bank, what it is doing, it is putting on its rules and regulations, or no, either it injects cash into the money market, or it squeezes the cash from the market into the money market. So that is there. Next is they act often, we call it as a nucleus of money market because the existence of commercial banks is there. This is very important in money market. So commercial banks existence is there, and some specialized financial houses are also there, like liquidity. No, sorry, like acceptance houses, discount houses, guarantee houses. So they are all part and parcel of money market. And the competition here in money market is essential, and it is always between lenders and borrowers of funds, and it will be between different banks, different bankers, and sometimes bankers and government also, and in corporate operating people also in the money market. So competition is the lifeblood also, we can say, in the money market. So existence of good number of tradable bills in the money market is another feature of money market. Okay, if in the absence of it, there is no steam in the money market. And money market consists of large number of sub markets like call money market, bill market, discount market, all these things. Now, what are the main instruments of money market? Yeah, number one is bills of exchange. So you might be getting confusion and all. Madam is saying these things are they are being traded and all this. Now let us see one after the other. Bills of exchange or commercial banks. So these are the bills. Generally, they come from trade, domestic, as well as no international. What it is actually is it is drawn by one party, we call it as a drawer, and to another party we call it as a drawee, to pay some amount. Okay, either in on demand or on a specified dates. So we call it as a bill of exchange. Okay, commercial bill. These bills normally have a maturity of 91 days, and some grace period also would be given, that is three days. They'll write a bill, okay, so and so date, so much amount has to be paid and all these things. Okay. So unfortunately, the market for bills of exchange is not so developed in this developed money markets. Excuse me. And what are these treasury bills? Treasury bills and this ad hoc treasury bills, they are drawn by the central and state governments. So this is between governments. Okay, it might be state government or central government. They are state to state government and all treasury bills. Okay, exchequer we can call it. These treasury bills have a specific maturity duration period. It may be 91 days or 182 days or 364 days. So they are also called as self-maturating, self-maturity papers, and because they can be easily brought into cash, that is liquidity is very quickly done, and they are considered as less risky investments because they are issued by government. So this is treasury bills. Next is certificate of deposits. Certificate of deposits is like a bank deposit receipt issued to the bearer to receive some interest. And the certificate of deposit, no, it clearly specifies the date, the amount to be repaid. Okay. And normally the maturity period that varies from 3 months to 5 years. And the investors in these certificates, they receive higher yield compared to bills of exchange and treasury bills, but they are very risky. Okay. Sometimes if there is a default, no total loss would be there. So certificates of deposit are very risky. Next is commercial papers. They are low cost alternative to investors and traders to mobilize funds in lieu of loans on the security of their receivables or inventories. They have maturity period varying from 1 day to 270 days, and they can be discounted through money market financial institutions, and they are also risky investments but give higher return. Okay, so so that means something should be kept, and then on that security and all that, some amount would be taken, and that have to be repaid. That is commercial paper. Then repurchase agreement. These are the agreements which facilitate banks to sell or borrow from the RBI or other banks. So, repurchase agreements. These agreements are sold by the sellers with a promise to buy them again. Okay, at a given price and a specific time frame. So, similarly, a buyer can also purchase them to sell back to the seller. So, that's why repurchase. It is these instruments through which the repos and reverse repos of the RBI influence availability of credit. So this decides repurchase agreements decides the repo rates and reverse repo rates, which has to be prepared by RBI. So that's what you have to understand. Next is bankers acceptance. So a banker's acceptance is a short-term debt instrument which is issued by a company and that is guaranteed by a commercial bank. Okay, they are similar to treasury bills traded in the money market. They can be discounted at face value in the secondary market. Bankers' acceptance vary based on the amount of repayment duration. Generally, the maturity period of this bankers' acceptance is 30 to 180 days from the date of issue. So they enjoy the status of negotiable instruments. Yeah. Next is capital market. So what are these capital markets? So in simple terms, if you want to understand, money market is for short duration, whereas capital no for long-term funds. Okay, long-term funds. It provides resources which are needed by medium and large-scale industries for investment purposes. So it deals with funds with more than 1 year maturity. Okay. See what according to Herbert E. Doggle, what he is saying, capital markets are very complex, a complex of institutions and mechanisms whereby intermediate term funds, loans up to 10 years maturity, and long term funds, longer maturity loans and corporate stocks are pooled and made available to business, government, and individuals, and where instruments that are already outstanding and transfers. So to understand it further, no, with this definition, what you have to understand is capital market, no, it is facilitating, in one words, capital formation. And that capital formation is for the industrial growth and economic. Okay, number one. Number two is it is providing medium term funds and long term funds. What to meet no fixed capital needs. Yeah, to buy land or big machinery or to construct a building for a big company and all funds can be collected from capital market. Number three is it is giving an opportunity to small savers to become the partners of a big companies. Okay, okay, we'll give you some investment in that. You give us some shares of your company. So like that, they are becoming partners also. Then number four is it is attracting funds for investment into bonds, securities markets, even from the public, and also they are yielding higher level of return in the form of interest earnings. And it is also attracting funds from foreign investors, both directly and institutional level also. So it's giving an opportunity to firms to plan for expansion of their business, expansion of their capacities, product diversification, so as to reap no benefits of economies of scale and scope. See, economies of scale is, see, if you are going for market and taking 1 kg of tomatoes, they will say 10 rupees per kg and all. And if you say that I'll buy 10 kgs, they may reduce the price, isn't it? They may reduce it to even 4 rupees, 6 rupees per kg, they may give you. So that is nothing but when you are buying more, the price would be getting less. That means you are saving something, that we call it as economies of scale. Okay. So that is provided by capital market. And likewise, it is giving an opportunity to even financial institutions to earn good return on their investments. So this is all the major thing what capital market is doing. Okay. Yeah, now we'll see the structure of Indian capital market. See, yeah, one of the most important components of capital market is the market for government securities. So we call it as gilt edge securities. So topmost gilt edge securities. Then we have industrial securities market. Again, in this we have new issues and old issues market. New issues for the new companies and old issues for the existing companies. Okay. And in third, we have development financial institutions, which are Industrial Finance Corporation of India, SFCs, that is State Finance Corporations, Industrial Credit and Investment Corporation of India, that is ICICI, Industrial Development of Bank of India, IDBI, Industrial Investment Bank of India, IIBI, Industrial Reconstruction Bank of India, IRBI, and Unit Trust of India. All these things are the institutions which are operating in capital market. Number four is a number of financial intermediaries are also operating. They are merchant bankers, mutual funds, leasing companies, venture capital companies, and others. Okay, so this is the structure of Indian capital market. Yeah, we were talking about government securities and gilt edge and all. What it is? See, government securities, they are nothing but they are all bonds, all treasuries that are issued by the government for especially to raise public loans. Okay, these securities are usually we call it as gilt edge securities, as repayments of principal amount and even the interest amount. They are totally secured, being first charge on the nation's purse. So nation's purse means government's purse, no, treasury, exchequer, right? So the government securities we can classify into three categories depending upon their maturities. One is long dated, medium dated, and short dated. Long dated and medium dated and short dated. Okay, this is no exceeding 10 years from the issue of date, that is long, medium from 5 to 10 years, and short within 5 years. So depending on this issuing body, we can again classify the securities into five, that is central government securities, state government securities, securities guaranteed by central government for all India financial institutions, which we have seen, no, IDBI, CSA, and all. And fourth is securities guaranteed by state government for state institutions like state electricity boards, housing boards, all they come. Then is treasury bills issued by RBI. They are all government securities. Next, we have industrial securities market. So these are again no business corporate usually mobilizing funds from stock markets through issue of industrial securities in the form of equity shares, preference shares, debentures or bonds. Then we call it as industrial securities market. So here we have ordinary shares, preference shares, and debenture or bonds. See, ordinary shares, the corporate through public, they issue shares, mobilize funds from the market for fixed capital investments. And these shares offer an opportunity to the people to invest their ideal savings in the ownership of these shares. And these investments do not fetch any interest income, but they yield a return in the form of dividend income. And this instrument is useful for companies as they are relieved of the interest burden if they have to finance their activities through a borrowed fund. See, for example, a company is in need of funds. Now, what it does, it issues shares. Now, say we people we have some amount in our home. Instead of keeping it as an idle saving, what we do, we invest in that company. Okay, and company is getting some amount, and with that amount, it will expand its business. So, in turn, what they do, they give us some dividends. Okay, from the profit they divide it and they give us as income. So it's good for both company and we, isn't it? Because idle savings were there and we have put it in investment in the companies, and we have taken some equity shares. In turn, we are getting some dividends. So it's a win-win situation for both the company and the people who have idle savings, isn't it? So this is how things are by buying ordinary shares. We call it as equity shares as well. Okay. Next, preference shares here same, but thing is we get a voting right here in case if you have to. Uh, Sorry, no voting rate for the equity shares. We will get there. This is all dealt in companies law. So preference shares, unlike ordinary shares, they have a fixed rate of return. Whereas ordinary shares, no, it depends upon the profits. See, when the company is earning more profits, they will get more dividends. If they are getting losses and all, they won't get any dividend. Instead, they have to wait for a period to get their dividends. But whereas in preference shares, it is fixed. If it is decided when they are issuing, only that 2% would be given, and that 2% would be maintained whether they get profit or not, whether they are in losses, but they have to pay the dividends to these preference holders. Okay, so likewise in preference shareholders, we have cumulative preference shareholders and non-cumulative preference shareholders, convertibility, yeah, convertible and non-convertible would be there, redeemable and non-redeemable, participating and non-participating preference shares. They are all there. Accordingly, uh, the people would buy the shares of those companies. Okay. Now, whereas debentures, they are unlike, they are not like shares. Bonds are given, and in shares they get dividend, but in debentures, if they are buying any debenture of a company, they are getting some interest. Okay, with a fixed time limit for repayment. Okay. Uh, these again can be no registered bonds, bearer bonds, redeemable bonds, perpetual bonds, convertible bonds, right bonds, okay, non-convertible bonds, and partly convertible bonds. All these things. And what are the So before that, just we have to also know about financial intermediaries. These are asset based and fee based, and they provide services as per the requirements of the clients. Okay, like we have insurance companies, we have mutual funds, we have non-banking financial intermediaries, right? Now, these are the regulatory authorities of Indian financial system. Apex one, as I told you, Reserve Bank of India. It's the leader, and it would be controlled controlling all the credit of the country, and it's a custodian of nation's monetary gold and foreign exchange reserves. And they control commercial banks ability to create credit also through quantitative and qualitative methods, the credit control system. And the Okay, so RBI is no, it's equipped with additional powers also to to control the other financial market institutions. Okay, that is they need to regulate all financial markets. Payment system should be controlled. Payment structure should be controlled, like real time gross settlements (RTGS) we say. They have to control that. That is where the interbank payments are settled on real time and gross basis in the books of RBI, RTGS. Then we have SSS, Security Settlement System is there. Clearing Corporation of India Limited, that is CCIL, that is settlement of transactions in government securities, foreign exchange, and money markets in the country. Okay. And then we have negotiated dealing system order matching, we call it as NDSOM. This brings transparency in secondary market transactions, especially in government securities and all. Okay. So these are all the functions of RBI. And then not only that, they have to supervise also. Offsite supervision is there. That is all financial market system institutions. They have to make self-assessment. They can call for any information. A system of alerts also are given. Audit and controls are taken by RBI. And prior approval of changes, if any, they have to do that. Now, apart from this, inspection and supervision, they have to control also. So for that, inspection has to be done, and they have to regulate and supervise the trade repositories and all these things. Okay, so it truly means it's an apex body in Indian financial system, which is controlling the whole financial system: capital markets, money market, financial institutions, banking institutions, non-banking institutions, everything, full credit, savings and credit, both quantitative and qualitative. All these things are regulated by RBI. Next is Securities and Exchange Board of India. We call it as SEBI. See, the growth of this stock exchange transactions resulted in this, in the growth of malpractices also in the stock market. So that has to be curbed. So the main, reasons or various malpractices which is seen is, price rigging, unofficial premium on issues, delays in delivering of shares, and see Harsha Mehta scam, and even you see this Lucky Bhaskar and all, you'll come to know the functioning of all these things, SEBI and all these things. The price rigging, unofficial premium on new issues, the delays in delivery of stocks and shares, and violation of stock exchange rules and regulations. So these are all affecting. See, customers, they are not very much interested in dealing with SEBI and all these things. So they came the things like how to control this, how to overcome these problems. Then the government of India, what it has done, it has established Securities Exchange Board of India, that is SEBI, and it is established in 1988 as a non-statutory body. The main objective is to regulate the functions of securities market and provide orderly and healthy developments in the stock market. Okay, and so main objectives of this SEBI is: first one, to protect the interests of investors in securities. Number two is to promote the development securities market. Number three is to regulate the securities market and all other matters that are connected to securities market. and to prevent any fraudulent malpractices. As I told you, price rigging, unofficial premium on news issues, delays in delivery of shares, and violation of stock exchange rules and regulations. That has to be prevented. And last one is to regulate and develop a code of conduct for intermediaries, such as brokers and underwriters and all. Okay. So in other words, SEBI has three primary functions. Okay. One is legislative function, uh, and judicial and executive. Okay. Now Kazi legislative, Kazi judicial, and Kazi executive. Legislative function means it is drafting some rules and regulations related to instruments and institutions. Okay. Executive, it conducts some investigations and enforces some actions. And judicial, it passes some rulings and orders on matters of any disputes which are related to securities. So like that, these three functions are there. And other functions are, to protect, to train the intermediaries, to frame some rules and regulations, to frame regulations for the intermediate merchant bankers, brokers, underwriters, registers, and all, and also to register and regulate mutual funds, take over of companies, and conduct inquiries and audit stock exchange, and all these things. These are the main, we can say, functions of SEBI. Okay. Next is insurance regulatory. Yeah, Insurance Regulatory and Development Authority of India. We call it as IRDAI, Insurance Regulatory and Development Authority of India. See, this has come into existence in 1999 on the recommendations of Malhotra Committee. Okay, and the main objectives of this IRDIA is, very first thing, to promote the interests and rights of policy holders. Okay, so related to insurance of policy holder, policies would be there. So interests and rights of the policy holders must be safeguarded. Next, to promote and ensure the growth of insurance industry, to ensure speedy settlement of genuine claims, and to prevent any no malpractices or frauds. Next, to bring transparency and orderly conduct in financial markets dealing with insurance. So all these things are taken care by this IRDIA. Next is Forward Markets Commission, that is FMC, that is future contracts. Future contracts. Okay, forward. These are the contracts between buyers and sellers to buy or sell commodities or currencies or shares at a future date on a pre-contracted terms and conditions relating to what price and quantity of sale. So future trading. Future trading, no, it has some benefits. That's why it has come into existence. What are it is? It is it shields the traders from the risk of fluctuating prices. It helps the farmers to plan their cropping pattern based on the future prices. So that's why this has come. And the main objectives is of this FMC is to regulate future markets in commodities, to ensure financial and market integrity, and to protect the rights and interests of consumers. Now, for that, what it is doing, it is advising central government in related to recognition and withdrawal of any association, and then it supervise and control future markets. It collects information and conditions on conditions for trading of commodities, and it makes some recommendations to the government to improve what can be done for the future market and all these things. And the last one is Pension Fund Regulatory Development Authority, PERDA, with PFRDA. See, this is established in 2003, and it is acting as a regulator for the pension sector. So whoever gets retired and who are getting pension from the government for the services in the government sector. So in 2014, it has been passed and it is acting as a statutory authority. And the main objective of this is to help government employees, central government employees, and that after the retirement they get all the benefits and all. The major function of this is to promote pension scheme in the country by fostering mandatory as well as some voluntary pension schemes, so as to serve old age income people who are retired, and regulating the NPS system, that is National Pension System, appointing various intermediate bodies or agencies like pension fund managers, central record keeping agency, we call it as CRA, they are all working for this, and educating the subscribers and the general public on issue related to pension and training of intermediaries and addressing some many problems related to pension. So all these things are taken care by this PFRDA. Okay, so this is all about regulatory authorities. Yeah, any doubt till here?
No,
No.
ma'am.
Okay, then we'll move forward. Okay. Yeah, what are the measures initiated by the government to reform this financial sector? Because we know how financial sector is important for the growth of agriculture, for growth of industries, for the growth of small scale industries, for the growth of medium scale industries, for the growth of large scale industries in various forms, no, in the form of capital market, in the form of money market, in the form of banking institutions, in the form of non-banking institutions. So therefore, some measures must be taken to reform this financial sector, because changes are inevitable and things are changing day by day. So hence, government also should take some initiatives to strengthen financial sector. No, so what the government is doing is, see, RBI started reducing the SLR and CRR in a phased manner, right? That is savings liquidity ratios and all these things in a phased manner. Just a minute. Yes, call from. Yeah. Uh, yeah, that is no. Yeah, this what the RBI is doing is it's trying to reduce this statutory liquidity ratio. What it actually is, it's a ratio of liquid assets to the demand and time liabilities of a commercial bank. So if they reduce it, and even this cash ratio also, uh, cash reserve ratio also in a phased manner, then there's a possibility that more investors would be taking loans from the bank and all, and savings can be pooled. So such things are done. CRR is 4% against 15% maximum permitted by law, and they deregularize the interest rate, both the deposit rates and lending rates also. Except savings account and NRE deposits on the deposit side, and export credit and small loans on the lending side. All other interest rates are deregulated. So in 2011, savings bank account rates were also deregulated, subject to a base minimum rate. So that's why they say savings zero based accounts are almost no change. That means they have to maintain current accounts and all. Some amount must be kept in your savings account. No, for example, HDFC always demands that you should at least keep 5,000 in your account. So like that. As regards capital adequacy ratio, norms schedule commercial banks are required to maintain this capital adequacy. No, this much must be there. That is 9%. While Indian public sectors are emphasized to maintain at least 12%. So like that, some measures are taken. All these things are the measures taken by RBI. And see, fifth one, if we look into what RBI is done, it is determining prudential norms and provisionizing. The bank were directed to classify their assets as substandard assets, doubtful assets, loss assets as a norms fixed by the RBI, and then make provisions. So I think they are helping the banks to whichever the assets are not good, let us dispose of and all these things. And for quick recovery, both bad debts and settlement act is passed, and that is Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Act 2002, that is SAFI CBC. And what these banks are doing, they are allowing banks and other financial institutions to auction residential properties or commercial properties to recover their loans. Okay, that's how financial sectors are recovered, are reformed. Then autonomy to banks is given, especially for grant of they uh, they can decide on their interest rate and all, but this is only on paper. But the full autonomy is not given by RBI. And RBI also has given willingness to transfer its entire shareholdings to SBI, NHB, NABARD, and all these things. And RBI also started liquidity adjustment facilities. Okay, wherever the principal operating instrument for modulating short-term liquidity is there, repo rate and reverse repo rates, they have become a key policy in monetary policy of the economy of the country. Then merger of some commercial banks also has taken. Yeah, see, Visa Vijaya Bank has now become a Baroda Bank of Baroda, and all these are all merger of commercial banks. Okay. Yeah, if you have any doubts, you can ask. Okay, then next block will start at some other time. Okay, happy Sunday to you all.
Thank you, ma'am.
There are no doubts.
Happy
Thank
Sunday to
you.
you, ma'am.
Thank you. Shweta and V. Srinivas. Okay.